Hello, everyone. As we near the end of 2023, we at Wealth Trust Capital Services have come up with our 2024 market and wealth outlook. 2023 was a mixed bag for most economies. As US grappled with high inflation and rates, Europe continuing its struggle with high gas prices, and China with its debt burden. India was a dark horse, which sprung back stronger and continues to be an economic sweet spot. The commodities market also had its share of fluctuations. Oil prices took a dip due to the concerns of oversupply, whereas copper witnessed a decline on account of subdued Chinese data. Gold, on the other hand, continued to hold firm at elevated trading levels. So, to wrap up, the global economic tapestry is intricate. While the US stands tall with its economic robustness, the global landscape offers a mix of equity performances, bond market shifts, and diverse inflation trajectories. For India, understanding these global dynamics becomes very crucial as we navigate our own economic journey in the coming months. To discuss further on the Indian equities and the bond markets and how commodities can be placed within your overall asset allocation, and our analysts Shubham and Aman will take us through a bit of what to expect on the domestic front. So over to you, Shubham.
Yeah, hi, thanks Neha for the lovely overview. On the equity front, the market have moved adversely to what the notion is of the markets and rates. While the central bank raised the rates, the market still kept going higher and higher due to the increased investor awareness and obviously because of the high corporate earnings. Now, from the macro perspective, we see good opportunities in large cap sector. The large caps can do really well in the coming months, and the valuation for mid cap and small caps are also looking attractive. The broader index rally in mid cap and small cap was due to the poor quality companies, while the higher quality and high growth companies were discounted at higher rates due to the significant, rise in the interest rates. So, now most of our investors are confused. Should they sell the current holding or wait for the dip to buy again? Moving forward, we recommend investing in more quality companies and adding to the current holdings would be preferable. We also prefer an active quality approach wherein we focus more on the top slice of the pie, provided one has an excellent approach in the large caps. So basically, a flexi cap approach moving forward with a bias towards large caps would be preferable. That's all from my side. Moving forward, Aman will give us a quick brief about the fixed income part. Over to you, Aman.
Thank you, Shubham, for that quick brief on the equity markets. On the fixed income markets, we do like bonds, however, not the Indian bonds per se. To give you a brief, the Indian bonds have performed poorly. That is majorly due to how the economy has been for India. Despite the rate hikes, the economy has done pretty well, and we do not expect the RBI to cut rates spontaneously or in an abrupt fashion as would the US Federal Reserve. So instead of the Indian bonds, we rather recommend, or we are more positive on the US bond market, wherein the yield spreads between the 10-year and the 2-year bonds have fallen significantly. And given how the US economy is, we expect the Federal Reserve to cut the rates in a much more abrupt fashion as opposed to the RBI. So we could potentially see a good price rally for the 10-year or the longer duration bond prices. So that is on the bond market. So we are more overweight or of outperformance rating on the US bonds as opposed to the Indian bonds. Onto the commodities, the commodities have been in the background, but again, the performance has been majorly lackluster. If you look at the gold, so this data is of a 6-month rolling return for gold, Nifty, and government bonds. So if you look at it broadly, the gold has performed pretty well in the past one or two for the past 6 to 12 months. However, we only expect a modest upside, but that doesn't mean we are totally underweight gold or anything. But however, we rather recommend having a gold allocation as it provides a good hedge against the market volatility. despite the valuations being stretched for the overall market, the market has still been rallying. So in case of a correction or any sort of slowdown, gold would certainly be a good hedge for your portfolio as a whole. Just before we move on, uh, there's an interesting slide that we made: in growth we trust, in high rates we live. uh, the higher rates we believe will affect the cost of capital for a lot of companies. And despite the market rally, we fear, there's a risk of adverse outcome, which the markets might not really be prepared for. So yeah, that's on my part.
Thank you so much, Shubham and Aman, for the very insightful comments on what to expect for 2024. To conclude, and how we are looking at 2024. So we maintain an overweight stance on large cap companies. We definitely feel large cap will do much better than the small and mid cap companies, at least for the next 1-2 years. We recommend being very cautious with poor quality companies, and we definitely feel that the momentum story is a little overdone, and quality companies will definitely do better in the mid and the long term, medium to long term segment going forward. Definitely prefer the active quality investing rather than doing a standard value or growth style, because neither a growth style or a value style will do justice to your overall portfolio. And that's why quality investing is definitely something that one should look at. We have definitely an overweight stance on the US bonds. Given the high inflation in the US, we may see the Fed cut rates, and this will definitely help the prices to go up, and definitely there could be some we are overweight on the US bonds, noting these factors. But on the Indian bonds, we maintain a neutral stance. Maybe the next year will be a flattish year for the Indian bonds, and we may not see any price increases there because of the interest rate. We don't expect the interest rates to be cut so soon for the Indian bonds. And from a commodity perspective, we are very positive on gold as an asset class, and definitely it should be added in parts to hedge your portfolio. We do not expect a very high upside, but yes, definitely a modest upside. The idea of adding gold is more to hedge your portfolio than really a very large portion of your investments into commodity. So yes, that's it from our side. What we are saying in 2024, be cautious than being very, very optimistic, because things are going really well for India, but maybe the year could be more for quality and not for investing through momentum and stuff like that. To end, if you want to read more on our market outlook and the yearly outlook, we have a full read available. So please click below on the link to view our report in full. Thank you so much.